Good evening once again, and you're all welcome to today's edition. We're on a series of how to build a strong financial foundation. And previous weeks, we've considered a lot of points. We've dealt with the education and knowledge, entrepreneurship, savings and investment. Just last week, we finished the savings. And from the savings, we realized that there's what is called seed and bread concept, which simply and treats us that any money that we get, we should understand that there's a portion which is named as bread, and there's a portion which is also termed as what? Seed. That we are supposed to eat the bread today to satisfy our current needs, and also the portion that is termed as seed should be used for what? Tomorrow. We should plant it for what? Tomorrow. Because one may ask, my own is too small. I can't save because the amount I am earning is too small. But we all know there's no seed which is big as a building or a tree, but it has that potency, that power to grow and become a giant tree which will bear much fruit. You see, so just one seed, it has that ability to give you too many fruit or so much fruit. Even with this, let me buttress it with what our fathers, that's those from rural areas. We know that our fathers, during the harvesting time, especially harvesting maize and other things, some of them, that's the wise farmers, some of them, they will put some of the seeds somewhere and wait for another season for them to plant it. Those who enjoy all the seeds they got from the harvesting, they will end up going hungry tomorrow because they will not have anything to rely on. But those who catch some of the seeds that they will replant it another time, they'll end up getting plenteous. For instance, maize, you can put just one seed of maize down, but the maize has that one seed of maize has the ability to give you over 100 seeds of maize when it matures. This is how savings are. Even though they are small, but never despise them. They have that ability to give you a giant fruit one day. Last week, before I ended, I said that, so after you've kept the money well, you've gathered all the money, you've gathered all the seeds, what should I use it for then? And that's what brings to today's teaching. So let's talk about investment. When we say investment, what do we mean? Investment simply means acquiring assets that has the ability to generate incomes, or acquiring an asset which value increases with time. One, the asset has the ability to generate income, and secondly, you can have an asset or you can have something, an item, that its value increases with time. You get it? So then it becomes an investment. Why did I bring this? Because for instance, someone can buy a house, put his money into buildings. The building with time, the value increases. That is all. That it gains appreciation. It becomes an asset. You get it? Aside if you or she getting returns from rent and other things, with time, the value of the thing will also increase. What are some of the things to consider if you want to do investment? So as I made mention of what is called an asset, I use an asset to explain investment. What is then an asset? So they are the things that help us to, or that generate money periodically. They are what? Assets. The things that generate money periodically. So the first thing you must consider is your investment plan. From savings, we considered what is called, what is pursuing you will determine how fast you run. And what you're also pursuing determine how fast you walk. You get it? For you to consider an investment portfolio, you must consider what is called your investment goals. Because if you know that you want to buy a house in the next 5 years, you then know the type of investment you must choose. If me, I know that I want to buy a house in the next 2 years, then I should know the type of investment I should consider. If you want to build a mansion within 10 years, It will help you to know the type of investment to choose. You get it? So that's the first thing. And the second one is what is called profitability. You see, high profit is equal to high risk. That's the chances of you losing your money. So to choose a particular investment to go into, one of the things you should consider is what the profitability rate. If the profitability is high, it tells you that your chances of you losing the money too is high. The same way, if the profitability is low, then you have high chances to maintain your money. Your money is well kept. If your profitability is moderate, which means your chances to is moderate, whether losing or gaining is moderate. You get it? All right. And the next thing you have to consider is your risk tolerance. You get it? So we have people who have high appetite for, high risk appetite. You get it? Yeah, I know a friend who can risk anyhow. You get it? Yeah. And it is based on the person's background, where he started from, the kind of things he has encountered. It has given him the endurance or the capacity to hold certain risks or deal with certain risks. But probably this is your first time maybe trying that particular investment. You get it? Yeah, so it is necessary that you consider your risk tolerance. Next thing you need to consider is what is called liquidity. Liquidity. What is liquidity? How fast you can turn your assets into cash. Let me give you a classical example. Have you seen? iPhone has high liquidity. If you want to convert your iPhone into cash, you can easily trade it. Someone is ready to buy it than other phones. That is what is called liquidity. How fast can you turn your assets into money or into something else that you need? So in liquidity, we say that there is always an equilibrium between the buyers and the sellers. The sellers are ready to buy any quantity that you have. The buyers too are also ready to sell any quantity they have. You get it? So that is what is called liquidity. So in considering the type of investment to do, it is prudent to consider what? The liquidity of that particular investment. Because if you know, that one will even help you to determine the duration that you must choose. So in considering investment to do, these are the four things. One is what? Your investment goals. Two is your what? Profitability rate. And I said what? Your investment goals will determine the kind of what vehicle you must use or the kind of portfolio you must enter. And then your profitability rate. Also, high profitability is equal to high chances of losing your money. And three is what? Your risk tolerance. Your ability to cope with risks. Your ability to manage risks. You get it? And the last one is what is called liquidity. And I said that what liquidity is about how flexible your investment is. Investment with high liquidity means that you can easily or quickly trade it or convert it into what? Cash. You get it? All right. So these are the four things you must consider in order to choose what investment I should go into. There is a hard truth I have to let you know. The hard truth is there's no good investment anywhere. There's no good investment anywhere. Why am I saying this? Because every investment falls short at one of these things that I just listed, especially the three. That is the profitability, the liquidity, and the risk tolerance. Because investment with high interest, high profit, is difficult to trade it for your money. And it's also difficult. It's also likely that you can lose your money. You get it? And investment with easily tradable, you can easily convert it. It doesn't have much profit. You get it? So this makes it difficult to get the best investment to do. And this leads me to what is called diversify your portfolio or diversify your investment. Because for you to be able to manage higher investment that comes with higher profits, and also investment that comes with what? Low profit. What do I mean by low profit? I mean investment that has high liquidity. You can easily trade it for your money. You get it? For you to be able to manage it well, that's why we have to learn what is called diversifying your investment or diversifying what portfolios. In our old adage, we say that what? Don't put your eggs in what? One basket. You get it? Or diversify your investment or diversify your portfolios. That's what we mean. Don't put all your eggs in one basket. Because if you put all your eggs in one basket, that is maybe that basket is the one that has the high profit. Therefore, it has what high chance of you also losing the money. So if it doesn't turn well for you, you lose everything. You get it? The same way, even though you have to consider that is maybe choosing the one with a low profitability. The high profitability is also important because you're two-sided. It can happen that maybe it will turn to your good. It will favor you, to go in your favor. You get it? So it is always prudent that what you consider, you blend the two, you mix them up. So you put some into the investment, the ones that guarantee small profit. You put some into ones that guarantee what? Moderate profit. You put some into ones that guarantee what? High profit. So that the day the high profit will go down, you already some to supplement the others. The day you will lose one, you will have another one to what? Regain faster to supplement the other one. Do you get it? So this is important to what? Diversify your portfolio. This is the reason why. The only way in order to manage your risks. In order to ensure a quality and well-returned investment to do. The next thing that I want us to consider is what is called rules to investment. What are some of the rules I must follow if I want to do investment? One, don't invest in something that you don't know. You don't have any knowledge about. So before you invest in, make sure that you understand. We have what is called 3 E's when it comes to investment. So the 3 E's, we have what is called education. We have what is called experience. We have what is called what? Excessive cash. Excessive cash. What do I mean? Before you want to consider any investment, make sure that you have knowledge in that investment platform. Don't just stand up and enter any investment. You get it? So that's the education. You must be well educated about where you are going. Another one, the experience. There are some people, they've done it severally. They know how it is done. That is, especially those in the trading market. They know the seasons in which a particular asset increases faster. That's the experience. You get it? They know the season in which maybe that crypto coin is likely to shoot. The hot season, thank you. The bull season. You get it? And we have what the last one I said, what? The excessive cash. You have to get cash to do investments. Now I need cash over here. Alright? So you have to what? Get cash to do the investment. Especially the footballers. They have excessive cash. But they don't have the education about which investment they should do. That's why they need to consider getting maybe a financial coach or financial advisor. You get it? That they have the excessive cash. And we have people who are well educated, but they don't have the money. Because as you are here right now, you are learning about investment. So you are becoming educated in terms of investment. But if you don't have the cash, you can't do it. You get it? So excessive cash is important. And we have people too who have the education. They have the excessive cash, but they don't have experience, so they end up losing their money. It's not that they don't know about the investment. They know. But they don't have the experience to know that this is the season in which I must enter this investment. And they will end up losing their monies. You get it? All right. So the next thing, the rules to invest, the next thing you should also consider, I think we've already talked about, that is what? Your goals, investment goals and plans. You get it? So as we've already talked about that, let me move quickly. The next thing is to consider is what? Don't desire for quick money or fast money. You have to be patient with your investments. Yeah. So these are the rules. But you should what? First thing was what? Education. And that's, you should know what you are going to invest in. Don't invest in something you don't know anything about. And that's how come a lot of people have been scammed. They don't even understand the investment. Yeah, they don't know what it is about. And they will just quickly jump into it. And the second thing is what? Experience. So, you should have experience about that one. It's a different thing. I just brought them under the knowledge, knowing, the 3 E's. You get it? So you should have that. You should have the knowledge, the education. You should have the experience, and you should have what? Excessive cash. Then the next thing, the next rule you must follow is what? Not to don't desire too much. Fast money or quick money. Be patient with your investment. The last thing I will talk about it, that is with the rules. You should also be concerned about increasing your investment base, increasing your asset base, enlarging your assets. You get it? As I rightly define what an asset is, anything that generates money periodically. You get it? What is a liability? So the opposite is true. Anything that takes money away from you becomes a liability. So mathematically, we can say that what? An asset is directly proportional to what? Time. Assets are what? Items or anything that increases in value with time. And assets are things or anything that also generates money periodically. You get it? So with respect to time, mathematically, an asset is equal to what? Time. That's an asset is directly proportional to time. The opposite is true. Therefore, liability is also what? Inversely proportional to time. Because if you buy a car today, depending on what you are using the car for, that would determine its definition, whether we can term it as an asset or a liability. But car in general itself, it's what? A liability. Because it depreciates with time. So it is inversely proportional to time. If you buy 200 today, tomorrow, if the economy is well stable, let me use that word again. If the economy is well stable, the following year, your car will depreciate. You get it? All right. So this is what is called asset and liability. Basically, we have 4 main types of investments. 4 main types. There are a lot, more than even 10. But the main ones we mostly consider are 4. One is what? Equities. Equities has to do with the stocks, the shares. Another one is called what? Bonds. So we have equities, bonds, and we have what is called ETFs. We have what is called what? ETFs. And we have another one that most of us are familiar with. I think way back when we were kids, we used to do some. That is mutual funds. Mutual funds. These are the 4 main types of what? Investment. We have other ones like the real estate, partnership, franchise system, those things, they are all there. After we've considered the 4 main types of investment, that is the equities, the bond, the mutual funds, and the ETFs. for you to be effective in doing this investment, there's a particular consciousness that you must work in. There's a particular mindset that you must carry in order to become effective in these investment portfolios. And this is why you have to join me coming next week to walk you through what I have termed it as what? Investment mentality. Because if it is not here, it can never be here. If it is not here, it can never be here. So I want to end here and thank you for coming. And I'm your humble servant, Mr. GDP.